Hey everyone, today we're going to talk about a massive multi-trillion-dollar problem that's often hidden in plain sight. I'm talking about corporate fraud. And look, if you're planning to be an auditor, understanding this threat isn't just part of the job, it's going to be your entire mission.
All right, let's just jump right in with one number, 5%. What do you think that is? A decent profit margin? Maybe just a rounding error? Well, the real answer is a whole lot bigger.
That 5%, that's the slice of all global revenue that companies lose to fraud every single year. We are not talking millions or even billions here. We're talking about a $5 trillion problem. That is the absolutely staggering scale of the issue we're breaking down today.
So, how in the world did we get here? This isn't some new thing. The fight against fraud has some deep, deep roots, marked by absolutely massive scandals that basically rewrote the rules for how business is done.
What's so interesting here is you can see a direct line from crisis to regulation. I mean, the collapse of giants like Enron and WorldCom, those weren't just shocking headlines. They were the actual reason we have the Sarbanes-Oxley Act, a law that completely changed the game for auditors. And as you can see, this wasn't just a US problem. As scandals popped up around the world, so did the reform.
Okay, so to really fight fraud, you first have to understand what it looks like out in the wild. And experts have this brilliant way of thinking about it. They call it a bestiary of corporate risks. So let's think of these threats as three distinct creatures, each one with its own dangerous way of behaving.
First up in our bestiary, we've got the Black Swan. And just like the name suggests, this is the one you literally never see coming.
Its real power comes from its rarity. Picture a CEO who's been with the company for 20 years, universally trusted, but they've been secretly cooking the books the whole time. Because nobody would ever suspect them, all the standard controls are basically useless. So when the truth finally comes out, boom, the organization is just completely unprepared for the devastation.
Now, let's totally switch gears and look at our next creature, the gray rhino. And this one, well, it's the complete opposite of the black swan. See, unlike the swan, the rhino is a failure of action, not a failure of prediction. It is that 2-ton threat charging right at you. Everybody sees it coming. A perfect example is the insane sales pressure at Wells Fargo that led employees to create millions of fake accounts. Leadership knew it was a problem, but they just ignored it until it was way too late.
And that brings us to our final and maybe most dangerous creature in the room, the white elephant.
This one is all about the power of a toxic culture. It's the classic elephant in the room. Everyone knows the powerful CEO's claims don't add up. Think Theranos. But they are just too terrified to challenge them. The problem isn't hidden at all. No, it's protected by a culture of fear and silence.
So when you put them side by side, the key difference really boils down to one thing: visibility. The black swan is a total shock, but the gray rhino and the white elephant? Nope. They are failures to deal with what's already known. Failures that come from either just not caring or being too scared to act.
All right, so now that we know the different shapes these risks can take, let's actually dissect the fraud itself. What are its core components? What really makes it tick?
This definition, which comes from COSO, that's the Committee of Sponsoring Organizations, is absolutely crucial. And the most important word in this whole sentence is intentional. Fraud is not a mistake. It is not an accounting error. It is a deliberate, calculated act designed to deceive somebody.
So, what would drive a person to do something like that, to intentionally deceive people? Well, way back in the day, a sociologist named Donald Cressy came up with a really simple but incredibly powerful framework to explain it. It's called the fraud triangle.
The first side of that triangle is pressure. This is the why. It's the motive. It could be something personal, like being buried in debt, or it could be professional, like management handing down totally unrealistic sales targets that create this do-or-die mentality.
The second side is opportunity. This is when the company's own defenses fall apart. Things like weak internal controls or a complete lack of oversight, or maybe just trusting one person with way too much power. These are the things that create an opening for someone to act and think, hey, I can get away with this.
And the final piece of this puzzle is rationalization. This is the little story fraudsters tell themselves to make it okay. It's the internal voice that says things like, I'm just borrowing the money, I'll pay it back. Or, after all my hard work, the company owes me this. Or even just, everybody's doing it, it's not a big deal.
Now, this table shows something fascinating, what we call the fraud paradox. Just look at the relationship between frequency and impact. It's completely inverse.
The most common type of fraud, asset misappropriation. We're talking stealing cash, faking expense reports. It happens all the time, but the financial hit is relatively small. But on the other end, financial statement fraud, your big Enron-style scandals, that's super rare, but when it happens, the damage is absolutely catastrophic.
So, we've seen the problem, we've seen the different creatures, we've seen the anatomy. So what's the solution? Where do you even begin to fight back? Well, it doesn't start with another rule or some fancy new control system. It starts with culture.
The single most critical factor in stopping fraud before it starts is something called the tone at the top. It's all about the ethical example set by a company's leaders. If the CEO is playing fast and loose with the rules, believe me, that message echoes through the entire organization.
And you see, culture isn't just some fluffy, abstract idea. It's a real system. It's a chain reaction. It all starts at the top, with leadership, setting the ethical values. That directly influences how employees act day to day. And then finally, you put in the formal policies and controls to reinforce the behavior you want to see.
And this is where you, the modern auditor, become the key defender against that whole bestiary of risks. Your job isn't just about checking boxes anymore. It's about having professional skepticism to question that white elephant in the room. It's about using powerful tools like AI to spot the charging gray rhino before it tramples everything. And ultimately, it's about having the guts to take your findings straight to the board, no matter how tough that conversation might be.
So, after all of this, what's the big takeaway? It really boils down to this one question. What's the bigger risk? The one you can't see, or the one you see clearly and choose to ignore? Is it the unpredictable black swan, or is it that gray rhino charging right for you? That's the question every auditor, every leader has to answer.